March 14, 2018. In a sterile conference room on the 45th floor of Blackstone Group's Manhattan headquarters, Stephen Schwarzman received news that would have been unthinkable just a decade earlier. China Investment Corporation, the sovereign wealth fund that had been Blackstone's largest foreign investor for over a decade, had quietly sold its entire stake in the firm. The relationship that had symbolized the golden age of U.S.-China financial cooperation was over. The sale netted China's sovereign fund approximately $1.9 billion, representing one of the most successful investments in the fund's history. But the timing was extraordinary. It came just days after President Trump announced tariffs on Chinese steel and aluminum, signaling the beginning of a trade war that would fundamentally reshape the relationship between the world's two largest economies. What happened next would reveal something profound about how America's financial elite were quietly preparing for a new Cold War, even as they publicly maintained that business could remain separate from geopolitics. The Blackstone-China relationship had been a case study in how money could transcend politics. Its dissolution would become a case study in how politics ultimately trumps money when great powers compete. To understand why China Investment Corporation's exit from Blackstone mattered, you need to understand how extraordinary their original partnership was. In 2007, as Blackstone prepared for its initial public offering, the private equity giant was looking for a marquee investor who could provide both capital and credibility. They found both in CIC, China's newly created sovereign wealth fund, which had $300 billion to deploy around the world. The timing seemed perfect. China was flush with foreign exchange reserves from its booming export economy and needed to diversify away from low-yielding U.S. Treasury bonds. America was in the early stages of a financial crisis and needed foreign capital to stabilize its financial system. CIC's $3 billion investment in Blackstone was announced as a win-win partnership that would deepen economic ties between the two superpowers. But the investment was controversial from the start. American politicians questioned whether it was appropriate for a Chinese government entity to own a piece of America's most influential private equity firm. Chinese critics wondered whether CIC was simply subsidizing American financiers with Chinese workers' savings. The stock price of Blackstone plummeted after the IPO, making CIC look foolish for paying premium prices for a stake in a firm that the market was valuing much lower. Yet CIC held on. Through the financial crisis of 2008, through Blackstone's turbulent early years as a public company, through numerous market cycles that tested investor patience, China's sovereign fund maintained its position. The relationship deepened over time. CIC became not just an investor in Blackstone, but a client, allocating billions of additional dollars for Blackstone to manage across various alternative investment strategies. By 2017, CIC's stake in Blackstone had grown to approximately 4.5% of the firm's equity, worth nearly $2 billion at current market prices. More importantly, the relationship had become a symbol of how financial interests could transcend political differences. When American politicians criticized China's trade practices, business leaders could point to partnerships like Blackstone CIC as evidence that economic cooperation was beneficial for both countries. That all changed with remarkable speed. The sale of CIC's stake was not a sudden decision triggered by Trump's trade war. According to people familiar with the matter, CIC had been gradually reducing its holdings over several years, sensing that the political winds in Washington were shifting in ways that would make Chinese ownership of American financial assets increasingly problematic. The writing was on the wall. Starting in 2012, the Committee on Foreign Investment in the United States, CFI-US, had begun taking a more aggressive stance toward Chinese investments in American companies. High-profile deals were being blocked on national security grounds. Chinese investors were being subjected to increasing scrutiny and regulatory hassles that made American investments less attractive. More fundamentally, the investment was becoming a political liability for both sides. American lawmakers were questioning whether Chinese ownership of Blackstone gave Beijing inappropriate influence over American economic policy. Chinese officials were facing domestic criticism for investing in American assets at the expense of domestic development needs. The broader context was equally important. By 2018, it was becoming clear that the era of unfettered financial globalization was ending. The Trump administration was weaponizing economic policy in ways that previous administrations had avoided. American financial firms were being forced to choose between Chinese relationships and American regulatory approval. For Blackstone, the writing was particularly clear. The firm was one of the world's largest alternative asset managers, with significant exposure to politically sensitive sectors like real estate, infrastructure, and technology. Chinese ownership of the firm could potentially complicate Blackstone's ability to win contracts with U.S. government pension funds, acquire assets in sensitive industries, or maintain relationships with other American institutional investors. CIC's sale of its Blackstone stake was not just a financial transaction, it was a signal that the golden age of US-China financial cooperation was ending. But it was also the beginning of something new, a massive, largely hidden reconfiguration of global capital flows as American and Chinese investors began the complex process of financial decoupling. The Blackstone case was just the beginning. Over the next 6 years, similar stories would play out across Wall Street as American investment firms gradually reduced their exposure to Chinese markets, while Chinese investors pulled capital out of American assets. The process was quiet, professional, and almost entirely hidden from public view, but it represented one of the largest capital reallocations in financial history. Fast forward to 2024, and the process had accelerated dramatically. Blackstone, the same firm that had once welcomed Chinese investment, was actively divesting from Chinese assets. In February 2025, news broke that Blackstone was in advanced talks to sell 3 logistics projects in China's Greater Bay Area to Ping An Life Insurance for approximately $372 million. The deal represented a major exit from a business that Blackstone had been building in China for over a decade. The logistics projects being sold were not just random real estate assets. They represented Blackstone's bet on China's e-commerce boom and the growing integration of the Chinese economy with global supply chains. Blackstone had acquired these assets when foreign investment in Chinese real estate was seen as a sure bet, driven by urbanization, rising consumer spending, and China's integration into the global economy. But by 2025, the calculus had changed entirely. Chinese real estate had become a minefield for foreign investors. The sector was struggling with oversupply, declining demand, and increasing government intervention. More importantly, American investors were facing growing pressure to reduce their exposure to Chinese assets as tensions between Washington and Beijing intensified. The sale to Ping An was particularly revealing. Ping An is not just any Chinese insurance company. It is one of China's largest state-influenced financial institutions, with deep ties to the Chinese government and Communist Party. The transaction represented not just a sale of assets, but a transfer of strategic infrastructure from American to Chinese control. This was the mirror image of what had happened with CIC's sale of its Blackstone stake 7 years earlier. Then a Chinese entity was divesting from an American firm due to political pressures. Now an American firm was divesting from Chinese assets for the same reason. The difference was that the American divestment was happening on a much larger scale and with much less public attention. Blackstone's China strategy had been one of the most ambitious attempts by a Western financial firm to build a major presence in the Chinese market. Starting in 2013, Blackstone had systematically acquired logistics, office, and residential assets across China's major metropolitan areas. The firm's bet was that China's economic growth would create enormous demand for modern real estate assets, particularly logistics facilities that could support the country's booming e-commerce sector. For several years, the strategy worked brilliantly. Blackstone's China real estate portfolio generated strong returns as the Chinese economy continued growing and urbanizing. The firm became one of the largest foreign owners of commercial real estate in cities like Beijing, Shanghai, and Shenzhen. Its success in China was held up as a model for how American firms could profit from Chinese economic growth. But the environment began to change around 2020. The COVID-19 pandemic disrupted global supply chains and reduced demand for commercial real estate. More importantly, the Chinese government began implementing policies designed to reduce debt in the real estate sector and limit speculation. Foreign investors found themselves caught in the middle of policy changes they didn't fully understand and couldn't influence. The final straw came with Russia's invasion of Ukraine in 2022. The war triggered a broader reconsideration of global investment strategies, as investors realized that geopolitical conflicts could quickly render foreign investments worthless or inaccessible. American investors began asking themselves whether they were comfortable owning assets in countries that might become adversaries. For Blackstone, the question became particularly acute because of the firm's close relationships with government pension funds, sovereign wealth funds, and other institutional investors who were increasingly concerned about geopolitical risks. These investors were demanding that Blackstone reduce exposure to Chinese assets as a condition of continued investment. The irony was that Blackstone's Chinese assets were performing reasonably well. The logistics projects being sold to Ping An were located in the Greater Bay Area, one of China's most dynamic economic regions. Vacancy rates were low, rental income was stable, and long-term demand prospects remained strong. From a purely financial perspective, there was no reason to sell. But investment decisions in 2025 were no longer made on purely financial grounds. Political risks had become as important as financial returns. American firms were being forced to consider not just whether an investment would generate profits, but whether owning those investments would create regulatory problems, reputational damage, or strategic vulnerabilities. The Blackstone divestment was part of a broader pattern of American financial firms reducing their exposure to Chinese markets. Goldman Sachs had been gradually winding down its Chinese investment banking operations. Morgan Stanley had reduced its China-focused investment funds. Even firms like KKR and Carlyle, which had once seen China as a major growth opportunity, were focusing their expansion efforts on other emerging markets. The process was being driven not just by government pressure, but by changing investor sentiment. American institutional investors, particularly public pension funds and university endowments, were facing pressure from stakeholders to reduce investments in countries with poor human rights records or adversarial relationships with the United States. The result was a quiet but massive reallocation of global capital. Money that had once flowed freely between the world's two largest economies was being redirected into domestic investments or third-country opportunities. The integrated global financial system that had emerged after the end of the Cold War was being replaced by something more fragmented and politically constrained. But the story of Blackstone's China divestment also revealed something else: the limits of financial decoupling. Even as Blackstone was selling its Chinese assets, it was continuing to do business with Chinese entities in other markets. The sale to Ping An was facilitated by Blackstone's ongoing relationship with Chinese financial institutions. The firm was not cutting ties with China entirely. It was simply restructuring those relationships in ways that reduced political risks. This pattern was being repeated across Wall Street. American firms were not completely abandoning China, but they were being much more careful about how they engaged with Chinese markets and Chinese capital. Joint ventures were being restructured to reduce foreign ownership stakes. Investment strategies were being redesigned to focus on sectors and regions that were less politically sensitive. The Blackstone case also highlighted the asymmetric nature of U.S.-China financial decoupling. While American firms were reducing their investments in Chinese assets, Chinese firms were continuing to invest in American assets, often through complex structures designed to avoid regulatory scrutiny. Chinese sovereign wealth funds, insurance companies, and state-owned enterprises were still major players in American real estate, infrastructure, and technology investments. The difference was that Chinese investments in America were facing increasing regulatory obstacles, while Chinese purchases of assets from American firms were often welcomed by Chinese authorities as a way of gaining control over strategic resources. The playing field was becoming increasingly tilted in favor of Chinese buyers and against American investors. This asymmetry was creating a long-term strategic problem for American financial firms. As they reduced their exposure to the world's second-largest economy, they were ceding market share to European and Asian competitors who were less constrained by political considerations. Chinese firms were building relationships with global investors that had previously been dominated by American institutions. The Blackstone buyout story was ultimately about more than just one firm's investment strategy. It was about the end of an era when business could operate independently from geopolitics. The idea that economic integration could overcome political differences had been one of the core assumptions of globalization. That assumption was now being tested by the reality of great power competition. As Blackstone completed its sale of Chinese assets in 2025, Stephen Schwarzman could look back on a relationship that had lasted for over a decade and generated billions of dollars in profits for both sides. But he could also see the future, a world where financial success would increasingly depend not just on identifying profitable investments, but on navigating complex geopolitical risks that could make today's profitable investment tomorrow's strategic liability. The Blackstone buyout had ended quietly, with professional handshakes and carefully worded press releases, but it marked the end of an era when American capital and Chinese capital could flow freely in pursuit of mutual profit. The new era would be defined by financial nationalism, strategic competition, and the recognition that money, ultimately, serves politics rather than the other way around. As Wall Street learned to navigate the new rules of financial nationalism, a different kind of story was unfolding in the war zones of Eastern Europe. While investors worried about profit margins, soldiers were fighting with weapons powered by technology that was supposed to be banned. This is the story of how sanctions become meaningless when war creates its own economy.